Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Okay, well, welcome everyone for our regular weekly research. More and more people are asking to follow this, so give us your feedback. And Joe, take it away.
Great. Thanks very much, David. Good morning, everyone. This is the research meeting for February the 19th, 2026. We're going to kick it off with a new investment with PL Capital. Before we do that, we just draw your attention to the fact that we're not providing direct investment advice here. Check us out at mcnicholasset.com. We'd love to hear from you. And we are professional investors, so give us a call. PL Capital is a firm that was founded in 1996. And so this is their 30th year specializing as one of a relatively small handful of banking specialist firms. And really the idea here is that they are investing, mainly in publicly traded community banks in the United States, but also with private holdings. And I think they're really value oriented. They do focus on their best ideas, and there's sort of an element of shareholder activism here. So they will occasionally exploit primarily like regulatory windows, and that's sort of the main theme here. So I thought it would be important to just sort of highlight that in terms of M&A. And you'll actually see in a subsequent slide that M&A in banking is sort of cyclical. So there's periods of several years where, not a lot of deals happen. And this slide here is really interesting to me personally, because I started working right around 2001. And I still remember one of the very first books I ever bought on finance was a book about the LTCM crisis, which was a big hedge fund that had Myron Scholes and a couple of other Nobel Prize winning economists on their board. And as I recall, it was a bet on the devaluation of the Russian ruble currency that brought them down. And so with banks, again, not a lot can happen for several years, but when something does happen, it really, really ricochets across kind of the entire financial system. So whether it was the tequila crisis, savings and loan, LTCM or the GFC, every so often there's something that happens that requires, major intervention on the part of, the Federal Reserve or whomever. And so I think that the overall thesis that PL Cap has is that by offering investors exposure to kind of smaller and mid-size banks, kind of in that 150 million to, let's say, $3 billion market cap range, they can really get out in front of a lot of these cycles. And so this is just an overview of the sizing of a lot of these banks. And you'll notice the United States has actually really been, first of all, a lot of us know this, but there's not like 10 times more banks in the United States. There's like 1,500 times more banks in the United States than there are way back up here in cold and snowy Canada. And that's sort of just the nature of the systems, right? Our model is more kind of that, big bank oligopoly, whereas the United States, to a certain extent, that secondary layer of their financial system is really regional. And so you can see a lot of the cap weightings here, but also the trend in consolidation among public and private FDIC insured institutions. And I think that is one important thing to just sort of highlight. This particular focus really is going to be on lenders that do have FDIC insurance. And there's been a lot of sort of discussions about, I guess, just how how FDIC insurance is, because you'll recall when Silicon Valley Bank blew up. I seem to remember that being as a result of some unpredicted or unplanned movements in either the 10-year or the 30-year, whichever one it was. It sort of exposed essentially that banks and the financial system is just a huge leverage mechanism. And so, all of these things are taking in money, they're taking in deposits, and they're lending out, 10 times the amount of dollars for loans. With that said, there still are some very attractive returns on the common equity that you can get. It is sort of, I would say, sectioned off by market cap. So you do tend to find, how shall I say this? The return on equity tends to be pretty good if you're kind of mid to small, but certainly from an efficiency perspective, obviously bigger is better, right? So I don't think there's any confusion that the PL Cap team is going to start, investing in Bank of America or JP Morgan. That really isn't the strategy here. It's really the strategy of, number one, exploiting this historical valuation asymmetry, along with the fact that there hasn't really been a sort of big period of deal activity in banks. And so they are kind of onto something. I'm still quite new to this group. The fellow that David had introduced me to there, Kurt Thompson, I think was really helpful at just helping, us understand the relative price to earnings multiple differential between things like the banks and things like, as an example, the NASDAQ. There is a slide coming up on the Mag 7 about that. But you can see here, there are some attractive, I guess, valuation dislocations or gaps between, things like banks, the Nasdaq, the S&P 500, and so this is really a value play, because for a while, as the expression goes, these banks were getting fined for, showing up at a meeting with the wrong tie, and so there could be some potential opportunity here. This one's really a nice looking chart, because it really points out how, kind of from a secular perspective, meaning like 40 years, several decades, there has definitely been a long-term secular trend in consolidation, and really a lot of these things were driven by legislation. So this 1985 Interstate Banking Act, which regulated interstate banking. So in the United States, each individual state is almost like its own mini country. Rumor has it that individual state governors sometimes have more power at the ground level than, the executive branch of the U.S. federal government. So this was essentially, this piece of 1985 legislation was superseded by a 1994 act that essentially removed restrictions on acquiring banks across state lines. And so it's really interesting that, this group is sort of, and they've been in the business, like I said, for 30 years. So they are not, new to this strategy, but certainly the aggregate M&A deal value by quarter. And this is that slide I kind of referenced at the front end. You basically see a theme here. So the theme is pretty much just sit around and wait for, a bomb to go off, wait for the fire and the smoke to kind of simmer down, and then just walk in and start snatching banks that have gotten, beaten up pretty badly. And if you have the liquidity to do it, it's actually not a bad strategy. It certainly is not without risks, but again, this group does have quite a lot of expertise in it. The next slide that I just want to highlight is just to sorry, let me just quiet down my phone, to sort of underscore the increased, I would say, appetite or desire in these sorts of transactions. Is really a good barometer for that is the number of months it takes to close these, $500 million and such deals. And that time to close is shrinking a little bit, and so that indicates that there's certainly an increased desire, I guess, to get some of these deals closed. Maybe the banks and the investors know that a little bit of consolidation is okay for shareholders. I mean, I'm not entirely sure that benefits the average bank worker, but it is what it is. So really interesting strategy there. It is new to our alternative program. As I say, it does invest in public listed bank companies, but also private ones. And so just sort of given that and a few other internal specifics, which are irrelevant here, it is an alternative way to play the banking space. Okay, let's just shift into charts of the week real quick. Andrew thinks that we are really in this what he calls a cat market, and what it means is that every time the S&P 500 has pushed to the edge of this support zone, it's produced a bounce. So it is kind of tricky to time the market, and I think we actually talked about that in our commentary, sort of the travails that can befall an investor if you kind of get too cute with market timing. So let's just get into the slides here. From a volatility perspective, the S&P 500 is neutral. So it's right up on that 50-day moving average, neither overbought nor oversold. The various support and resistance lines are there. I suppose if you kind of stare long enough at the upper right-hand corner of this chart, it wouldn't be surprising if your mind said, it looks like the S&P 500 is forming or beginning to form or starting to form sort of a topping pattern, in as much as, again, some of these new highs, these new all-time highs, are often met by sell-offs, but then the overall trend is sort of flattening out. And now here's that slide of the Round Hill Mag 7, the MAGS ETF. This one's really interesting because it very obviously shows that whereas the Mag 7, I guess a little while ago was leading the entire market. Like in fact, Apollo Fund Management put out a report entitled something like the S&P 493, which is to say the rest of the S&P 500 excluding the Mag 7. But now you can obviously see the breakdown in this particular ETF is signaling a little bit of concern here, because that 200-day moving average really needs to kind of step in and grab the market sort of by the collar or not the market, but this particular group of just 7 stocks, and pull it up back above that $62 mark. So we'll kind of see how that goes. This is the consumer discretionary ETF, the so-called XLY. And, it has hit that lower support line, the 200-day, the more smoother day, and then it has come back up. The issue with consumer discretionary versus staples is really just whether you're bullish or bearish on the economy. And so it did come down. I think this is more of a technical measurement. The actual underpinnings of the economy are sort of a different discussion. And so it looks like it did get a bounce. But the main thing here is whether that bounce is just a head fake or sustainable. Just taking a look at a few other areas here. Software. We talked about this before. It has had some pretty precarious. And so, with software, we talked about some specific names, which we don't get into here, but, companies like Constellation Software and a few others, Microsoft, having some challenges. So we'll have to see how the trend in software goes. The idea is that, AI is basically going to replace software and that sort of thing. So we'll have to see how that goes. And then the last one for me is this iShares Core US Ag Bond ETF, which, you can see the movements here. I think that, if you've been following Andrew's newsletters over the last couple of weeks and months, His comments on the bond market have really been that he doesn't have a comment on the bond market. It's been a little bit more volatile. It's been a little bit more difficult for him to call technically. So, in this case, he reckons that as long as AG squared remains above that $100 level, the balance of evidence is to the upside. That's it for myself. I'll pass it back.
Okay, great. Excuse me. Thanks, Joe. Ken, you ready?
Yeah, can you hear me?
Yeah, just fine.
Cool. I'm gonna share my screen. It's this one. There we go. So February 19th, weekly research. Just quick disclaimer on the front end. This is the same exact one that Joseph just shared. Just contact us today if you have direct security advice. And then same with this one here in the US for any viewers south of the border. Just quickly looking at these charts, S&P 500 had a 3-box reversal back to previous strong support. You can see there it's gotten to this level 3 times. Really a flat week, kind of flat start to the year for the S&P, flat to down. There's obviously been more weakness in the tech sector this week. Large caps as a whole, more of the growth names kind of continue to get hit. There's obviously the SaaS worries, which kind of continue to unfold, I'll call it. And then the overbought, oversold, -5%. That's the second straight oversold week. That's the first time since the tariff tantrum of about 10 months ago. On the momentum basis, negative all the way across. And then the price objective, slightly bullish. So overall, looking a little bearish on the S&P, and same here with the NASDAQ. I had a 1-box decrease overall over the last week, but it created a second straight sell signal. That's the first time since last spring that has occurred. So tariff tantrum again. The tech weakness obviously continues to accelerate. The price objective, which is a technical data point, points to a lower price. So we'll have to watch that. It's below the 50-day moving average, just above the 150-day. We're on the longest negative weekly momentum streak since last fall. And then the overbought, oversold, heavily oversold. You can see that. It's the third straight week it's been oversold, and that's also the longest sell-off we've seen since last spring, and when Trump implemented all of those tariffs and used those fancy Bristol boards on the White House lawn. Looking here at the Dow Jones, 2-box decrease week over week. 2 column changes. It's the strongest U.S. index in 2026, end of this week. New line was supported. You could see some really strong support lines here for the Dow Jones. It's also 2 boxes from overhead resistance and creating another buy signal, which would be really positive. There was a bit of a weak week for some of the mega caps, especially in the tech sector. This week's loss is obviously led by Cisco and IBM, which were both down by about 9% over the last 5 days. The price objective remains bullish, overbought, oversold, positive, even though we had a slight decrease week over week. But it does seem like this rotation from growth to value is gaining steam, so we'll have to continue to watch that. And then looking at the TSX, it had a 1-box decrease over the week, but it had 2 column changes. So a bit of a pullback, just like we had a few weeks ago, followed by an immediate rebound. We're getting these nice lines of support, which is really paints a strong technical picture for the TSX. The TSX remains highly attractive from a valuation point on a relative basis compared to the US. Obviously, the TSX continues to be led by commodities and financials. The most weakness continues to be in the tech sector and even some industrial names. But really watching the TSX here, obviously, overbought, oversold is 53%. That's the highest in 5 weeks. So we're seeing a really big spread right now from when we're comparing the Canadian indice, which is commodity based, compared to the US indices, which are large cap tech tilted. So continue to watch that. Looking here at the VIX, 2 column changes over the last week. Continues to slow down. um, and move higher. You can see that continued trend. I've been pointing it out for a couple weeks now. It's basically a perfect trend along that red dotted line. Looks like for now we're going to continue to see increases. We've been in a positive trend now for 3.5 weeks, which is implying a higher VIX. So I'm going to have to watch that. I'll jump through these two charts. I've talked to them in depth in past weeks, and there were no changes. A percent positive trend. The NASDAQ continues to break down. Really underscores what I've been saying about the NASDAQ. Seeing the technical picture really break down for an expensive index. So I would say maybe perhaps look out below in the short term, just with some of the movements we've seen in some of these technical charts. Not a lot of movement here for the Canadian indices, so I'll just jump over this. This is a chart I wanted to talk about this week. We got some movement within the currencies and commodities, but not a lot of movement. Saw some buy signals lost within the precious metals area again this week, and we actually got overall weakness in the commodity space, really gaining strength in, I guess, non-risk on assets, cash, currencies, fixed income, and even what I will say is, for the most part, just pure valuation from a fundamental standpoint, not looking at anything else. International equities obviously trade cheaper. We've seen a rotation over there and towards some more value names, but within the domestic sectors, we continue to see tech and communication services free fall, and energy continuing to increase. It's almost gained 100 buy signals in the past 3 months. Basic materials has also gained a significant amount of buy signals, as has utilities. It hasn't moved as much, but for a very defensive industry, utilities has moved up in terms of the number of buy signals it has pretty significantly over the last few months. So something to watch there. And you can see here, you can just see the change in buy signals in some of these sectors these are the last few weeks. So it doesn't paint the long-term picture, which I had mentioned for energy and tech, but it does paint a bit of a short-term change for a rotation from tech and communication services and even financials into energy and basic materials and even some industrials. So something to watch there. I'm looking here. This is the Energy Select Sector Spider Fund XLE. On the left, you can see the melt up we've seen this year and the steady, consistent returns last year. We rotated into some more energy names over the course of last fall / early this year, and we're really happy with that. But on the right side is what's really interesting right now. That's a relative strength chart, XLE versus the S&P 500. The S&P 500 has been outperforming, according to this chart, XLE, since basically the peak of oil prices in 2022. Since then, we've had this grind lower. The S&P 500 has obviously outperformed energy equities. That has really changed since October, and we've seen a bottom and a complete reversal. We're one box away from a buy signal. And usually, dating back all the way to the early 2000s, I know this chart doesn't, those trends, when they rotate and flip, usually last for a significant amount of time. So something to watch there. Now, why has energy stocks done so well? Natural gas prices have come off a little, but they're still elevated. Uranium has done really well. Coal prices have actually moved up, but looking here, oil looks like it has really bottomed. It bottomed in the mid 50s. We're sitting at $65 now. You can see this long-term trend chart that has a resistance, which used to serve as support, which used to serve as resistance that's serving as support over the last few years. Obviously, we don't read completely into a chart like this, but nonetheless, I think with the recent move we've seen in the price of oil, perhaps that bottom, like I had mentioned in previous months, is in, and we will see some higher prices in the short term at least. Looking here, this is the Magnificent Seven as a share of U.S. net exposure. Obviously, we all know everyone's piling into the same trade. That doesn't make hedge fund managers different. The hedge fund net allocation to the Magnificent Seven is up to 22%, which is more than double the level seen in 2022 when it was in the 10 to 11% range. This is all happening when these stocks are obviously the most popular positions across retail. But the Mag 7's also all down year to date, underperforming the broader market. Goldman Sachs data analyst in this little research note mentions when does the rotation begin and when does obviously the investing herd move off of these Magnificent Seven names, or will they ever? We'll have to obviously see. And then just highlighting here, this is the ETF flows in the first 6 weeks of a year. Over the last 10 to 12 years, you can see just how much flow, how bullish sentiment is. We're at 245 billion in the first 6 weeks of ETF inflows, according to Bloomberg Intelligence. Despite markets trading within percentage points of all-time highs, valuations remaining stretched, investors are obviously piling in. And why is that? I think it's obvious. It's the AI madness. Big four hyperscalers are expected to spend about 610 billion this year on AI capex. This is just Microsoft, Meta, Alphabet, and Amazon. When you add in Apple, I think it gets to 650 billion. And then when you add on Oracle, it gets even bigger, and we're closing in on $1 trillion. Obviously, bullish from investors, seeing all this capex spending. Hopefully, these AI companies creating revenue. This morning, OpenAI was valued at some ridiculous valuation where they raised 100 billion, and some of the capital is basically going back to the companies that invested in them in the form of purchasing chips from NVIDIA, purchasing capacity from Microsoft, and so forth. So circularity in that trade continues, and I think that elevates the risk of the overall trade. Looking here at alternatives, that is not the USA, just because the US, like I mentioned, trading at a premium. We all know that. The MSCI World X US 12-month forward PE ratio is at 19 times earnings. Now, if you take away that brief COVID period, this is the highest level it's traded at, dating back to the financial crisis, other than a brief period in 2015. So even though the US is relatively more expensive, international markets still, compared to their historical averages, expensive. And then this is just looking at investing in real assets. I mentioned the capex spending in tech sectors, which is growing and we'll call the new economy. In the commodity sectors, we've seen years of underinvestment in capex. Companies have been discouraged in expanding production, and obviously they just are doing their maintenance capex. So that's why I think some of these commodity prices will continue to boom, purely because these producers cannot increase their production in the short term, even if there's demand. Now, just looking here, this is EQT, obviously a natural gas play in the Appalachian. They had a double beat this week, extremely strong quarter, outperforming obviously the S&P this year. Has had a bit of a pullback from its 52-week high, so trailing the S&P 500 slightly in terms of a one-year return, and it does trade at a bit of a premium relative to its peer group, but that's because it has superior margins when it comes to its business line. It's obviously a fully integrated natural gas play. We've been looking at it for quite some time, and we own some in select client accounts, obviously, but a really strong quarter, and I think the forecasts look really strong from a cash flow perspective. And then looking here, this is a really interesting slide that I just wanted to highlight. I ran by this. I was going to save it for another time, but it's just talking about bonds and diversification from equities. and how the correlation we all know of stocks and bonds has increased pretty substantially in recent years, which decreases the core diversification benefit of bonds. And that's why we've been saying for almost a decade now, and we've been seeking alternatives like alternative assets, which Joe had mentioned, precious metals, and then even portfolio insurance, which allows your obviously equity portfolio to remain fully invested no matter what period of the market you're in. And then I just wanted to end off this week with just talking about, obviously we're seeing this rotation from growth to value, from offensive to defensive. You can see here the S&P 500 consumer staples forward PE ratio is at its highest point since the dot-com bubble. Now, I think I obviously was not around. From what I've read, there was a rotation into some staples at one point. Everything was expensive at that point. But at this level, investors are paying a premium for companies that are not expected to grow at a rapid rate. So we'll have to see what happens, obviously, down the line, and if this rotation continues away from growth. And that's it for me. So I'll pass it back to Dave.
Thanks, Ken. Yeah, that's quite a telling slide, the final one, that people are already postured to be defensive. And maybe that's that proverbial wall of worry that maybe the market's going to just continue to dominate, especially on the technology side, the new world, as you called it. Okay, let me go through a few things here.
February the 19th, 2026. My name is David Clark. I'm one of the analysts here at NASDAQ Dorsey Wright. Taking a look at yesterday's action, mostly positive for the indices we follow on the video. We saw bonds slightly negative, international currencies as well. From there, we saw commodities notably to the upside, with crude leading the way up almost 4.5%. Most U.S. equity indexes are in positive territory. NASDAQ 100, NASDAQ Composite leading the way to the upside there, up roughly 80 basis points. As for crude oil, seeing it hold support there at 62, reverse higher here to 65. From here, we move above 66, matches that resistance we've been watching here in the near term, and also counts as a second consecutive buy signal. So something worth continuing to monitor there. As for gold on its default point and figure chart here, reversing back into X's after giving that initial sell signal at this point, move above 50-50 would return it to a buy signal on that default chart. As for the Dow Jones Industrial Average, reversing back into X's there with yesterday's action of 49,800, developing further support in that 49,000, lower 49,000 range. Russell 1000 reversing higher as well after holding support there at 3,700, and also seeing the Russell 2000 reverse higher after putting in another higher bottom here at 2620. From here, move above 2720 would be its second consecutive buy signal and match the January chart high. Moving on to individual stock names, we see quite a few with earnings related news over yesterday's close and this morning's open around it. From yesterday, Carvana, we had a profit miss and fade outlook is sending shares lower this morning. Ultimately, we've seen them trade at about 320 pre-market, showing the potential of a second consecutive sell signal if we see that move below 328 there. We do see additional support around 308, 312, but we've already seen pretty notable breakdown as far as moving into a negative trend, now seeing that second sell signal for the stock. Now moving on to DoorDash, up about 9% this morning after mixed results, but an improved forecast, and ultimately has sent shares higher. We've seen it at points this morning touch that 190 range. From here, move above 192 would return it to a buy signal. But again, worth bearing in mind that we're seeing this as a pretty notable rebound out of very oversold territory and what had been the lowest level for the stock since April of last year. So still seeing it as a lower attribute 2 for 5 here, but one that's rebounding off of those low levels. So something just to keep in mind. Then looking on to Occidental Petroleum, OXY, up this morning, trading at about $49 range, looking like it might match the September rally highs there. From here, some resistance in the lower 50s that we'll keep an eye on, but that move to 49, if we see it, puts it near the top of the trading band. So potential for exhale is something we would look for there as well. Moved on to day. Looking at Walmart, had a little bit of a muted outlook this morning, ultimately sending shares lower, trading at 122. This coming after reversing down with yesterday's action to 126, making all-time highs earlier this week, or but towards the end of last week, pardon me there. So seeing it continue to move lower towards the middle of the trading band, and moving 118 marks the middle of the trading band in the 50-day moving average, worth bearing in mind there. So currently trading at 122. As far as chart action goes, fairly healthy chart action, at least for the moment. So something just to monitor there. If you see further downside into those 110s, move below the 50-day moving average, might be a little something else to it there. Now, moving on to Deere and Company, John Deere, also reporting this morning, they beat and lifted their outlook for 2026. So seeing shares currently trade at 627, showing the potential of giving that second buy signal and also improving on recent highs there. This one had been sort of one of those that we saw consolidate for so much time that it's taken a little bit of time for this attribute to catch up to the near-term positive action. But if we continue to see it sustain, look for further attributes to potentially increase there for DE. But something to keep in mind that we're seeing it trade to those highs this morning at 627, a move above 632, would mark a new all-time chart high as well as a second consecutive buy signal on the chart. But that'll wrap us up for this morning. Jose, if you have any questions,
Okay, that's some interesting things at the beginning. I wish he wouldn't get into so much company stuff, so let me hide that. Hysteria beneath the calm. So yeah, here we go with just more data signals and 1 month absolute move, index absolute move. Yeah, this is just stats, just showing that we're back up to the same levels as the financial crisis and the dot-com. That we've been saying this for some time. So this might be the very beginning, or it could be another false move. But that's a actually powerful chart. I just don't know exactly what it's measuring. The rotation enough to keep the bulls alive. So he's not doing any. Oh, there's his right up. Historically, whenever we've seen this number of blowups, it's been amidst a crisis. The only time we've seen this level of carnage within 5% of all-time highs was the bursting of the dot-com bubble. Yeah, there's just so many likenesses to this, but look at how many times it's bounced up there, according to these surge and blowups and new highs. It's been pretty much since 2012 or 2013. Wow. Which one will close the gap? Historically, software and NASDAQ have been a near perfect correlation. While software has been pummeled, semis are treading water. But what if we hit peak AI hysterical hysteria, capex? So that's telling you something about AI has just got way too ahead of itself. The spectrum of AI beneficiaries. So all over again. So this is interesting. You got your labor costs on the left, and you got your exposure to AI on the bottom. As stated, the concerning thing to me is that the companies up and to the right, high potential for AI automatic to reduce labor costs equals improve margins, have been precisely what's been hit the hardest these past few weeks. Sign of a rational market. Yeah, so software especially has been killed. Interesting charts people come across. These 5 tech companies alone have tripled the annual capex figures since 2024. Since the end of 24, post-child, NVIDIA is up a whopping 24%. Poster child. Referencing my point from last week about operating cash flows, increasingly diverted away from capital return. 90% of operating cash flows in 2026 will be spent on capex, buybacks. The AI build-out makes the dot-com era look like child's play. Not only have stock prices reacted negatively to a recent upsize in capex, but this is the first time it's in the entire history of the survey that investors feel companies are over-investing. For all the arguments that these companies are building to win the future, our job is to evaluate the market impact. The same was said during the dot-com bubble. When did the tech regain leadership? Years after the massive capex outlay and when they became capital light businesses again. BCA has the data to prove how markets respond to capital light versus capital intensive. Shareholders really enjoy those dividends and buybacks. Okay. The labor market differential. The labor market continues to hint at further weakness. How will cyclicals hold up if we see a steady rise in the unemployment rate? Better yet, how long can AI capex prop up the economy? Seems to be a theme here. Demonstrates efficiency, margin improvements from AI. Stock doubles despite the ongoing freight recession. Just kidding. A penny stock karaoke mining company published a white paper. I don't know what that means, but he's getting a little esoteric here. Okay, 5-year treasuries. Remarkable how this trend line has held so firm in 5-year treasury yields. Given the action in commodities, I struggle to see a major move lower. That said, if we do break down, it might be the result of a major risk-off event that sends us cascading into the ones, as in 1%. Yeah, government would like that. They could refinance favorable rates. S&P 500 versus emerging markets relative performance. We like this trend of rest of world versus U.S. equities for the next few years. However, conditions may present short-term mean reversion. The rest of the world versus U.S. trade has been getting a lot of attention lately, but it's been on an absolute tear since January 2025, up 25%. But now we hear of record bearishness on the U.S. dollar. This positive divergence in relative performance may be a warning sign of a sharp reversal. Okay. Emerging markets on absolute price basis are providing a negative momentum warning. US dollar versus the Mexican peso. Mexico has been one of the hedge fund favorites post-Liberation Day freakout. We're starting to see some momentum warning signs of a potential reversal in a very crowded short US dollar theme. And that's it. So yeah, he really gets into the weeds and he's picking some tops here, and maybe we're here, but once again, we won't know until down the road. Yeah, markets are getting dinged a little bit this morning, but not off terribly. But looking at all the indices year to date, you've got some negative in the NASDAQ and a little bit in India. And the 1-year numbers, we've pointed those out week over week, are very strong. And especially on the venture exchange in Canada. It continues to be a great place to hide or invest. Crude looks like it's tracking nicely, and nat gas has had a good month. Gold's actually just holding in there, whereas silver has still showing a little bit more volatility, and that's the hangover for that 2 or 3 Fridays ago, January 30th. I remember it was the last trading day of the month that it magically got crushed. Copper not doing much. That's it. And I'll comment on Canada US dollar later. Bitcoin is not a place to be. Still has positive numbers out in the 3-year, but barely in the 5-year. So just highly volatile. And then I'll do something on interest rates. So hopefully I can jump over here. Can you see my the MAAM playbook?
Yep.
Okay, great. So it works the way I used to be able to do it. So US dollar hasn't moved much and still has the same upside of 78 cents and downside of 62. So it's stuck in that range. Same as the US dollar spot index at 98 and actually measures up according to this. Maybe I'll just take a quick peek at what it actually looks like here. So you can see the trend has been clearly down for all of last year with Trump in power, and looks like it's sort of bottomed here at 96, and it's just starting to trend up a little bit. So we'll see if that 103 number is correct. And if it is, it will have some negative effects on parts of the market, including our precious metal holdings, but we're not going to be trading them. They're really there as a theme against inflation, which prevails, and it appears. Okay, you talked enough about crude, but yeah, it's got a higher measurement of 81, nat gas down, the producers flat, copper down, the uranium down, gold flattish, and up on the spot price above to 5,500. Whereas the gold bug and the Van Eck both measure down, and the juniors measure down. So same for the silver. So yeah, gold as a commodity might continue to hold in there. Moving on, yeah, Bitcoin, now that number measures down to 22,000. So get out of the way. But Ethereum now, that's odd, that's reversed. And so has Solana, but the crypto index has not. Okay, the big bank in the US, as they showed on that one chart with the whole AI thing, labor's supposed to be helping them, really hasn't been helping their stock prices. But the regionals look stronger, so I'm glad we've got that position in place. And good update there, Joe. Whereas the Canadian banks look like they've got a lot further to go here on the upside. And finishing up with interest rates, no change there for the 2-year. The 5-year, actually, that's changed. So that's measuring down now from 3.6 to 3.3. And that's what Michael Coolbaugh outlined before. So just have to take a look at the trend here. Yeah, so if this could break down, if it broke down below 3.5% or lower, then I think his prediction might be accurate. The 10-year measures up and the 30-year measures down. So you've got sort of a sine wave curve here for the interest rate curve. And that's it for me. I don't think Sean's here today. Did I see him arrive?
No, he's not here. He's got an appointment.
Oh, did he? Okay, I missed that. So that's enough for me. Chris Curry, do you want to take it?
Sure, Dave. Thanks. Happy to. We had a strong market in the in bonds over the last week, which has brought rates down. The rates seem to have plateaued in the last couple of days. But Tuesday was an extremely active day in the investment grade issuance. Over $1 billion of in Canada bonds were issued. So issuers they're definitely on the sidelines. When the market's available to them, they'll certainly generate a lot of supply along those lines. A couple of news items I wanted to point out. I think that politics are going to become more and more meaningful as we head into the U.S. midterms. And today is Trump's first Board of Peace meeting. So we'll see what the commentary about that is, and what the outcome of that is. Also, in terms of trade, just looking at the headlines here, the U.S. trade deficit widens sharply in December, in contrast to what Trump is saying about tariffs. And in Canada, the trade deficit narrowed, but that's mainly a result of metals exports, in specifically gold and silver. I get the feeling that the economic numbers are really not going in Trump's favor. So, I'd be looking for some changes there as we head into the midterms. That's it for me, Dave. Pass it back to you.
Yeah, I heard the exact opposite this morning on the U.S. trade figures, and that they're being positive. So I just don't know if this is media manipulation, or is it real data that you're looking at, or is it just headlines?
I'm looking at Reuters. I'll click on it here. The U.S. trade deficit widened sharply in December. Goods trade gap highest on record in 2025. So that's from Reuters is the source there.
Okay, no, I trust that more than mine must have been a BS one, but I can't find it now. So yeah.
But yeah, but I just saw though on Bloomberg that Canada's looked like it was expanding its trade deficit. So we'll find out in the fullness of time. Paul, you made it.
Yeah, I made it. Unfortunately, I'm not sure what input I can make this very week. We're having a good start to the year, and it's basically a continuation of all the themes we were investing in Q4 last year. The silver volatility, right, was just awesome to watch. I've never seen a commodity go down 35% in a single day. After reading all about this for the last, 10 days, probably spending 3 hours a day studying the silver market, we've come to the conclusion, or at least I've come to the conclusion that the guys that are messing around with silver prices in the West, in the US and the UK, the reason they're doing this is I think they make a lot of money trading the volatility. So all they need to do is enhance the volatility dramatically, and you can make a fortune, trading vol. So when we were buying silver calls early last year in January, we were paying 23% vol. 23 was the lowest, but somewhere south of 30%. And now the vol on silver calls is in the high 80s, low 90s. And so I think that's one of the motivations is, these banks can make a lot of money if suckers like us play around with, very high vol. So we're basically overpaying for all these options and stuff. And it's a paper market. So our view is a Chinese holiday, right? Right now, 9 days they're not trading. And you would expect silver to fall substantially. I guess that was the big fear that because they were the biggest buyer. And it's a strategic metal in China, too. They're the biggest supplier to the world. And anyway, it's all being determined over there. And yet silver's not falling. In fact, you look today, silver's up again today. And I think we've come to the conclusion that if you're going to bet, silver's probably more likely to hit $150 than it is to go back to $60. So what have we done? We've gone and bought the 5 near-term producers. So guys that are going to restart existing or previous mines and take advantage of building cash flow this year, right? In the next 12 months, maybe go out 18 months, but call it the next 18 months. And if you do that, there are 5 companies that we've identified, and we think all of them are good for a move of, forget 30, 40, 50%. No. We're talking 100, 200, 300%. Upward movements, because people will recognize the cash flow multiple once they're in production. So, basically play the Lausanne curve in silver. And because you can't buy, if you go buy silver right now in the options market, you're going to be paying, $110 for an ounce of silver. And what's the point of buying that when spot's at 80? And then you can go buy these companies that you're buying silver in the ground at like $30 or, well, forget that, $20 or less. So that's it. We put it in our monthly letter, which you guys should all be getting today. Anyway, so there's Exelon, Silverco, anyway, a bunch of silver names. And I think that's a great play. We're putting 20% of our fund into these 5 names. So we're going to take a good sized position. And if they do what we think they're going to do, which is go up, threefold kind of thing, then there's your return for the entire fund for the next, 12 to 18 months. And you're done. Sell everything else and go home. So that's the one big trade we're putting on. And then this MDA, a big announcement today, right? They're spinning out a new division. It's all related to defense in Canada. And Carney announcing defense spending, right? He's going to take it up to 5% of GDP. That's never happened in our lifetime. Although we committed to it, we've never done it. And so Canada going to 5% is a huge number. And I'm not even sure how he gets there. But I think it's not that hard. You just buy this company called MDA Space and play the defense trade. Play the space trade and the defense trade. You get them both in one company. And that stock's going to list on the New York Stock Exchange this year. I mean, this is no-brainer territory. Just have it a major position in your portfolio. And it's our second largest holding. And then I'm just going to leave you with this. The Canadian stock market is so cheap that we own like 15 companies now that traded less than 3 times EBITDA. And I beg anyone to find me anything in the United States that trades at 3 or 4 times EBITDA. I mean, it's ridiculous. So you've got the oil patch is cheap. You've got the metals market is cheap. And that makes up basically half the stupid index, right? And so all those the energy service companies are all down at those kind of multiples or lower. And so the Canadian market's going to outperform the U.S. just simply because there's so much value in our stocks. And a lot of these stocks are, listed in Canada, but they're not Canadian plays, right? So they're international plays, but they're just cheap. So that's why we're going to outperform. You can buy NVIDIA if you want it 40 times cash flow, but why bother? Why don't you just buy Eris Gold, our largest holding? The thing is trading at 2.5 times EBITDA. Take a look at. I'll leave you with one more, right? They just announced their earnings last night, right? Is the B2 Gold? The stock's down 10% today. Okay, so it's gone from 2.5 times cash flow to 2.2 times cash flow. I don't know, but anyway, we're buying this stock like crazy right now because we can't find a $10 billion company anywhere in the world trading at. It's got a $10 billion market cap, and we think they're going to do about 4.5 billion in EBITDA. So why are Canadian stocks going to outperform? I don't know, because they're cheap. How's that? And that's it for me.
Yeah, Paul, just on silver, First Majestic released their quarterly report this morning. You name the metric and it's up. Like just as one brief example, their quarterly revenues were up 170% compared to the fourth quarter in 24, and cash flow was up by something like $238 million on the year-over-year comparable periods. Like, again, earnings, EBITDA, revenues, doesn't matter. They're all substantially higher. And, First Majestic has moved, but it's moved because it's successful.
I mean, these silver companies, if silver just stays where it is right now, call it $75, some of these silver companies are going to be trading at software like returns, right? They're going to have, revenue at $75 and costs at under 20. So, yet unlike the software,
and the sell-off actually was actually a good thing, because now you can see it's obviously building that base at around $80. You go PDAC's coming up in a couple of weeks, but I bet you most people at PDAC are reckoning that $80 base in silver is like a springboard price to, like, you pick the number and it's there, but it's exciting.
It really is an exciting area because everybody's on one side or the other, right? They either think silver's way overblown and the whole thing's going to collapse, or, which is our view, that there is no silver left. The inventories are literally going to run out this year. The inventories. We're going to go to zero inventory on the COMEX and in England, right? Because we know what the deficits are, and we know what the inventories are right now, and we're in our 6th year, and the inventories are going to go. They're already down at minuscule amounts, but they're literally going to disappear. And then what? So I don't know. I think silver could spike, and then the stocks are cheap. I mean, how much of a return can you make? I don't know. I don't think anybody knows. But I think you gotta have some money in some of these equities, and I think it's going to be very exciting, frankly. And there are not that many. What people also don't realize is that the industry, you pile it all together, and you don't even get to like a tenth of the value of NVIDIA, right? I mean, it's just minuscule. So there's lots of natural torque, I guess, right? And here's a last prediction: Eric Sprott will be Canada's wealthiest person. And I was just talking to somebody the other day. I think he's almost there. He advises the Thompson family. Apparently the Thompson family is worth like $25 billion US. And I think Sprott's going to get there.
So he surpassed yourself, Paul?
Yeah, he's past me for sure. So anyway, there you go. That's the predictions. Eric Sprott, Canada's richest man by the time this thing's over.
This will be a quick one today, just a quick short report for Thursday, February 19th, 2026.
I love the title.
Well, I've got a clear bias, right? Anyway, so this is S&P 500. Once again, this is the broad look at the index going all the way back at the start of the bull market in 2009. Yeah, this is the concern that we've been looking at for some time. I think Joe pointed this out earlier in the meeting, and I think Ken did as well. This sort of sideways movement that we've been in since essentially October, which coincided with a rotation out of growth. We take a look at the NASDAQ 100. Joe, you did point out that this does look like, to even a back of the hand technical analyst, like a topping pattern, right? Something similar to what we saw maybe at the start of 2025. Obviously, we're not making any predictions here, but we're starting to see this sort of rolling over, and it's only a question of when does that actually materialize into something more. I think the better question here is, given what we've seen in the market, do we think investors are willing to be deploying new capital at these levels, at these valuations, on a relative basis? And I think when we look at history, the answer is probably not in the positive. We talked about this rotation into defense from growth. Again, just updating the chart, we see that this continues to move higher from here. And what we're also seeing here is market breadth. Now, we've pointed out the market breadth is getting stronger, and that's a good sign, yes. But at the same time, when market breadth extends high, there's not much more for it to go, right? Like, you want to be buying at the lows in market breadth, not at the highs. And so as we're continuing to stretch market breadth here, as measured by S&P 500 stocks trading above the 200-day exponential moving average, we're now reaching a level where the market didn't move much higher. So we're once again seeing more evidence that the market is somewhat stretched. This is looking at the near-term breadth, so the 50 day exponential moving average, same sort of thing. We're getting to this elevated level where there's not much more meat left on the bone for the trade. And finally, we're going to look at credit spreads here, which once again, we're at this very low level. I've taken a closer look at credit spreads here, so you can see over the last 2 years, but I think it serves justice to take a look at the last maybe 30 years here, where you can see once we get to these levels where credit spreads are this tight, around 2.5%, there's not much more upside. In fact, typically what happens is we see the market pull back in a material way from here. Once again, just something to be cautious about. If you're interested in a solution to concerns about downside risk, we have one here at McNichol & Associates with our partners at Universa. So please reach out to us if this fits your profile. That's it for me. Yeah. And I think that's probably it for the rest of us, unless anybody else has anything they want to comment on today. Okay. All right. So if you're watching this on YouTube and you've made it to the end, again, please like, comment, and subscribe, and we'll see you again next week. All right. Talk soon, guys.
Thanks, guys.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnicholasset.com to learn more.